If you believe that the most important thing in trading is strategy, then by the time you reach the end of this video, that belief will be completely shattered. And I'm not saying this based on books. I'm saying this based on my scars. Today, I'm not going to teach you any indicators. Today, I'm going to tell you a truth that makes many people quit trading, and only those who truly understand it are the ones who survive. Today's truth is very simple. If you don't have discipline, it's better to quit trading. Yes, this line is bitter. But I have never seen a truth more bitter than this in my life. My beginning was exactly like yours. When I started trading, I had the same dream you have today: more money, fast money, freedom money. I used to watch charts every day, watch videos, join Telegram calls. Every new strategy felt like, this is it. This is what will make me rich. But the truth was, I wasn't making money every day. I was burning hope every day. The biggest mistake wasn't the strategy. You might think the strategy was wrong. No. The strategy was fine. The setup was correct. The entry was textbook perfect. So why did the trade still go bad? Because I removed my stop loss. I broke my rules. I lied to myself. And that's where my real problem began. Discipline doesn't look like saying, I am a disciplined trader. Discipline shows up in your actions. Revenge trading after a stop loss hits. Increasing position size after one loss. Taking entries outside the plan. Not reviewing rules before entering a trade. Getting scared as soon as you're in profit. Holding on to hope as soon as you're in loss. And the most dangerous thought of all, let me take just one extra trade today. This is how trading turns into gambling. I wasn't a trader anymore. I had become a gambler. Slowly, I realized I wasn't trading the market. I was sitting in the market with my ego, my fear, and my greed. Every trade stopped being about money and became a question of my self-respect. And when discipline is missing, the market reminds you of your reality every single day. Then one day came when I saw a loss in a single day that was bigger than my entire monthly income. That day, the chart didn't break. I broke. I asked myself, if the strategy is right, then why am I wrong? That single question changed my entire mindset. In this video, I will tell you what discipline actually is. Why discipline is more important than talent. Why 9% of traders fail because of discipline. How discipline is built, and most importantly, when quitting trading is actually the smartest decision. If you truly want to become a trader, this video is for you. But if you're only chasing quick money, this video will make you uncomfortable, because truth is always uncomfortable. If you're still listening, it means there is still a trader alive inside you. In part 2, I'll explain where your lack of discipline really comes from in your life, and how the market recognizes it. If you think discipline is only a trading problem, that's your biggest mistake. Because the truth is, trading doesn't break your discipline. Trading reveals your real discipline. The market doesn't teach you new habits. It only brings out what already exists inside you. Discipline breaks before trading ever begins. Let me ask you a simple question. Answer honestly. Do you wake up at the same time every day? Are you consistent in your work? Do you follow rules in the gym, studies, or your job? Do you have a habit of quitting things halfway? If most of your answers are no, believe me, you won't stay disciplined in the market. I wasn't disciplined either. I won't lie to you. Late mornings. Making plans and not following them. Starting things with excitement and quitting when boredom hits. When that same mindset entered trading, it turned into chaos. The market doesn't run on emotions. It runs on rules. The market doesn't care if you're confident, scared, emotional, or in revenge mode. The market only cares whether you followed your rules or not. And discipline doesn't mean you'll never make mistakes. Discipline means sticking to the rules even after mistake. Most traders say, I'm scared of losses. No, you're not scared of losses. You're scared of the pain after the loss. Your ego gets hurt. Your confidence breaks. Self-doubt creeps in. That's where discipline collapses. The first signal of broken discipline is when you think, let me move the stop loss just this once. This trade is different. The market can't go against me. Remember this. The market never considers you special, and the trader who starts believing he is special is the first one to be eliminated. Why does discipline feel boring? Because discipline has no excitement. Same process, same boring routine, and humans hate boredom. But winning traders choose survival over excitement. That's why 90% don't last. 90% of traders don't lose because they can't read charts. They lose because they can't control themselves. The hardest thing in trading is doing nothing. Not trading, waiting. Letting the setup come. That's where discipline is truly tested. One day I saw the truth. I reviewed my trades, not charts, not indicators. I only looked at where I broke rules, why I broke them, and in which emotion. I didn't see the market there. I saw myself. Discipline is not motivation. Understand this clearly. Motivation is temporary. Discipline comes from systems. Without a system, discipline is impossible. And that's where everything changed. Consistency comes from system is non-reliable. Motivation is unreliable. It comes and goes based on mood, recent wins, and recent losses. Discipline cannot depend on motivation. Discipline must be built into systems. A trading system is more than an entry and exit rule. It includes position sizing, risk management, daily routines, pre-market preparation, post-market review, and strict limits on behavior. Systems remove decision-making during emotional moments. When rules are written clearly, there is no room for negotiation. You either followed the plan or you didn't. This clarity eliminates confusion and self-deception. Without systems, traders constantly justify bad behavior with emotions. Consistency is boring. It means trading the same setups repeatedly, accepting small losses, and avoiding excitement. Humans naturally resist boredom, which is why most traders fail. Professionals understand that boredom is a sign of control. Systems also protect traders during losing streaks. Losses are inevitable. A system limits damage and prevents emotional spirals. Traders who rely on motivation collapse during drawdowns. Traders who rely on systems survive. The goal of a system is not to win every trade. The goal is to execute perfectly. Results are a byproduct of execution quality over time. True confidence in trading does not come from winning trades. It comes from knowing you followed your process regardless of outcome. This confidence is unshakable because it is not tied to money. In the end, successful trading is simple but not easy. It requires structure, repetition, and emotional control. Systems make discipline possible. Discipline makes consistency possible. Consistency makes profitability inevitable over time. Tiradanjal Tiroi Sharatar. Trading is the most honest environment in the world. It exposes who you really are. The market does not care about your intentions, your intelligence, or your confidence. It only reflects your behavior back to you through results. If you lack patience in life, you will lack patience in trading. If you avoid responsibility, you will blame the market. If you seek instant gratification, you will overtrade. Trading does not change people, it reveals them. Many traders believe they can be undisciplined in life but disciplined in trading. This is a dangerous misunderstanding. Habits do not disappear when money is involved. They become stronger. The same mindset that causes inconsistency in daily routines shows up magnified in the market. The market triggers deep psychological responses: fear of loss, fear of missing out, greed, and the need to be right. These emotions are not created by trading. They already exist within the trader. Trading simply brings them to the surface. A trader who cannot accept being wrong will not use stop losses properly. A trader who needs validation will constantly seek confirmation from others. A trader with ego issues will oversize positions to prove something. These are character issues, not technical issues. This is why trading becomes painful for many people. It forces self-confrontation. Every loss asks the same question: did you follow your rules, or did you follow your emotions? Over time, traders either grow through this process or quit because the truth becomes too uncomfortable. Successful traders use the market as a mirror. They journal not just trades, but emotions, thoughts, and behaviors. They focus on improving themselves, not beating the market. Once the trader changes, results change automatically. The market is not your enemy, it is your teacher. But only if you are willing to listen. Most traders enter the market believing that success is hidden inside a secret strategy, a perfect indicator, or a powerful setup that only a few people know. This belief is the most expensive illusion in trading. Strategies are everywhere. Profitable strategies are not rare. What is rare is the discipline required to execute any strategy exactly as designed, without interference from fear, ego, or greed. A strategy is only a set of rules. Discipline is the ability to follow those rules when it becomes emotionally uncomfortable. The market constantly puts traders into uncomfortable situations: losses, drawdowns, missed trades, early exits, and periods where nothing happens. These moments are where discipline collapses. Most losses do not come from bad analysis. They come from breaking rules. Moving stop losses, adding to losing trades, entering early, entering late, increasing position size after a loss, or taking trades out of boredom. Each of these actions has nothing to do with strategy and everything to do with self-control. A disciplined trader accepts losses as a business expense. An undisciplined trader sees losses as a personal attack. This emotional attachment leads to revenge trading, overtrading, and eventually account destruction. The market does not punish bad strategies as quickly as it punishes lack of discipline. Discipline also means knowing when not to trade. The hardest skill in trading is waiting. Waiting for your setup, waiting for confirmation, waiting for the right market conditions. Many traders fail simply because they cannot sit still. They feel the need to always be active, which turns trading into gambling. Professional traders survive because they understand one truth: one good trade does not make you successful, and one bad trade does not make you a failure. Consistency over hundreds of trades is what matters. Discipline is what protects that consistency. Without discipline, even the best strategy will fail. With discipline, even an average strategy can produce long-term profitability. Risk management is not a technical concept, it is a psychological one. Every decision related to risk reflects how a trader views themselves, their capital, and their future. Traders often say they understand risk management, yet their actions prove otherwise. Oversized positions, emotional averaging, refusing to cut losses, and risking too much on a single trade are not mistakes. They are expressions of disrespect toward capital and self. At its core, risk management answers one question before every trade: how much am I willing to lose if I am wrong? Professional traders answer this question first. Amateur traders avoid it and focus only on how much they can make. This difference alone separates survivors from casualties. Capital is not just money, it is opportunity. Every loss reduces future opportunity. When a trader risks too much on one trade, they are unknowingly betting against their own long-term existence in the market. The market does not reward bravery, it rewards sustainability. One of the most destructive beliefs in trading is the desire to recover losses quickly. This mindset leads to increasing position size, lowering standards, and taking impulsive trades. The trader stops thinking in probabilities and starts thinking emotionally. Risk management collapses the moment trading becomes about getting money back instead of executing the plan. Proper risk management turns trading into a game of endurance. Small, controlled losses keep the trader emotionally stable. Emotional stability keeps decision-making clear. Clear decisions protect the system. This loop is the backbone of long-term profitability. Risk management also removes fear. Fear exists when outcomes feel uncontrollable. When a trader knows that no single trade can significantly damage their account, fear loses its power. This allows the trader to execute setups objectively without hesitation or emotional interference. Many traders sabotage themselves by increasing risk after wins. Confidence turns into overconfidence. The trader feels invincible and starts believing the market is predictable. This is often followed by one oversized loss that erases weeks or months of progress. Risk management exists to protect traders from their own emotions, both fear and greed. Position sizing is discipline in numerical form. It enforces humility. It reminds the trader that they are one participant among millions, not the center of the market. Respecting position size is respecting uncertainty. A trader who truly understands risk management does not obsess over win rate. They focus on expectancy and survival. They understand that losing trades are not failures, they are costs of doing business. This mindset eliminates emotional attachment to individual outcomes. Risk management also creates consistency in psychology. When losses are predictable and controlled, the trader's confidence becomes stable. They stop reacting emotionally to normal drawdowns. This stability is what allows traders to stay in the game long enough for probabilities to work in their favor. Ultimately, risk management is an act of self-respect. It says, I value my future more than this single trade. Traders who lack this respect eventually destroy their accounts, not because the market is unfair, but because they were reckless with opportunity. In trading, money can be replaced. Time cannot. Risk management protects both.